Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at some bulletin board hero stocks on Friday, the 12th of September. We're starting off with Aminex, where things have really been on the move to start September. We've had the vertical spike through the 200-day moving average at 1.03 pence. Looks like a very strong situation given the way that support so far has come in no lower than 1.18 pence, and that's really the stop loss on the buy argument on an end of day close basis. Ideally above that neckline support, we'll see a push towards the top of a rising December price channel as high as 2.1 pence over the next 4 to 6 weeks. You're cautious on the situation, obviously wait for a break of the recent range of 1.6 pence, or maybe look towards buying on any dip towards 1.2 pence or 1.18 pence, the latest low. This is especially the case given the way that the RSI is at 76 on the over and on the overbought side. At this stage, only back below the 200-day moving average, probably on a weekly close, would be outright bearish or imply a sharp bull trap for Aminex shares. Next up is UK oil and gas, where we have a long-awaited break to the upside. In fact, we haven't actually broken the June resistance, but we have broken what looks to be the resistance zone from the end of that month, around the 1.2 pence level. What we were looking for really is a sustained break of this red line. There was a decent close on Wednesday above it, but we had false breaks through the late June line. So basically the best thing here was to wait for a day when the low of the day was above that resistance. We had that on Thursday, so you can say now really that while there's no end of day close back below, let's say 1.2 pence, which is the floor of this June price channel, we're looking for a target towards 2 pence over the next 6 to 8 weeks. Could be quicker than that even, given the way that we've taken so long to consolidate between 1 pence and 1.2 pence over recent weeks. Finishing off with a chart which is just as dramatic, in fact, and that's Doriemus. The triangle formation has been in here for quite a while. This consolidation here between the 115-day moving average and the 200-day moving average to start September was sort of confirmation that we were due a breakout. This was seen as a continuation triangle, so that there would be a push towards the top of the range again, but obviously in these situations it does tend to pay to wait for the break to occur rather than just simply assume that it will happen. The view now is that while there's no end of day close back below the 200-day moving average, that's 0.15 pence, we'd be looking for a long-awaited push towards 0.3 pence, which is the top of a rising trend channel from May. That's it from me. More updates at spreadbetmagazine.com.